Good morning, everybody. Let's have a quick look at what happened in yesterday's budget. Just going to share the screen. I think it's recording. For anyone who's looking at this for the second time, and maybe hoping this will be a complete run through of what they saw live earlier on this morning, it won't be because we had a small technological issue revolving around me not pressing the right button. So this is a rerun. It won't necessarily be word for word what we said last time, but hopefully the content will be the same. And with a bit of luck, you can see the screen. So yesterday's budget, what happened? What we've tried to do is to pick up not everything, not every change that went through, but the key changes that I think will affect the person that's watching this presentation. So national minimum wage, there's movement there. Employment rights, quick mention in the budget about those, and I've picked up a few things. National insurance changes, perhaps the most trawled tax change in history, VAT on school fees. Capital gains tax changes. Inheritance tax around business and farm assets, there's some changes there. Inheritance tax on pensions, and then I've got a slide pulling together just general other stuff, background information. So what didn't change? It's always interesting when you talk about budgets. What didn't actually change? Well, corporation tax has been committed to the next few years, staying at 19% on profits of up to £50,000 per company, 25% on profits over 250,000. And if your profits are somewhere between those two, there's a sliding scale that you gradually get up to that higher level. Income tax allowances and thresholds have been frozen for some time now, and they remain frozen. The personal allowance is 12,570. That's a level which you don't pay tax at. 50,270 for a 40% taxpayer. And to get into the 45% bracket, you need to be earning 125,140. Same as they have been, same as they are today, going forward. What else didn't change? Well, politicians continue to lie and argue over numbers. Listening to the Radio 4 show last evening after the budget, there was a big argument around whether it was a 9.6 billion black hole or a 22 billion pound black hole. There was no argument that there was a black hole, but just the amount of it. Feels to me like, did the Titanic sink stern first or bow first? End result is it still sank. But never mind. And of course, for those of us that only tune into politics once a year or thereabouts, MPs continue to behave in a way which none of us would expect or would regard as acceptable in our day-to-day world. I find that a bit disgraceful, to be honest, but never mind. So I'm sure that you read and listen to the same media shows and magazines and newspapers that I do. And since July, we've had all sorts of horror stories. So these were some of the scare stories that have been. Now you'll notice I have a cauldron, well, poetic license. In the middle of our table, national insurance on pension contributions. Didn't happen. Taxing pension lump sums. Lots of people were taking lump sums out before yesterday, just to make sure. Didn't happen. Higher increases in employers' national insurance. Yes, they did increase, but nowhere near as much as some of the papers had last weekend. We'll have that to the cauldron. Okay, stop that filling up. CGT aligned with income tax rates. Yes, there's been an increase in CGT rates, as we'll see in a moment, but not up to the level that any of us were really expecting. Abolition of business property relief, agricultural property relief. It's not been abolished. Significant changes, but not been abolished. Abolition of tax-free uplift in CGT base cost on death. This is a bit techie. Lots of commentary in the tax technical press around this. It would have had a big impact, but hasn't happened. An abolition of holdover relief for CGT equally would have had a big impact, hasn't happened. So they were our scare stories. Skip through 2 slides there, just bear with me a tick. Okay, national minimum wage. National minimum wage, national living wage, been with us a while now, gradually increasing by quite some large margin at 6.7% in April 2025. For an over 20-year-old, £12.21 per hour, £10 per hour for those aged 18 to 20. And those age brackets are merging. So basically they're trying to catch the younger bracket up to the higher bracket. My basic math says that if you've got someone earning minimum wage, working 40 hours a week, 52 weeks a year, that's a full-time 52 weeks a year, a full-time equivalent £25,396. The problem we have here, of course, is inflation has been targeted at 2%. We've got 6.7% at the bottom end of the pay scales. We all know that there are people that are paid just above minimum wage, some people paid just above the minimum wage, and so on and so forth. You stick 6.7% at the bottom, everyone wants to be moved up. And of course, the 40% tax bracket didn't move. More people end up paying higher rates of tax. I have just added at the bottom there the point about care needed. HMRC are charged with policing minimum wage. We have seen in the last year a couple of clients who pay people at the lower end of the pay scales being targeted by HMRC. They've both come out fine, pleased to say. But HMRC are looking at things like salary sacrifice if you've got childcare being deducted from salaries, salary sacrifice car schemes. They're looking at things like timesheets to make sure they're not being rounded down. Because of course it's very simple if you round a few minutes off here, a few minutes off there to actually then trip under the national minimum wage levels, and that's painful and embarrassing. So I just flagged that there whilst I had your attention. Employment rights, there was a very brief mention about these in the budget, but I thought it was just worth mentioning a couple of points here that have an impact on us as employers. Number one is there is a change coming in, making it unfair to dismiss someone from day one. At the moment, there's effectively a 2-year period you can do that. I know there are some exemptions to that, but right now, unfair dismissal doesn't really exist in most cases until 2 years of employment. It is coming in that it will be from day one. Doesn't mean that you can't dismiss someone week one, month one, 6 months, 18 months in. But you just have to go through a due process, whereas maybe you don't have to right now. And the other thing is it is now a legal requirement to have a sexual harassment policy. That's not a policy to sexually harass people, but the other way around. And transgression of that, what the implications are, reporting processes, etc., etc., etc. If you don't have one and end up with a complaint or an employment case going against you, you will find almost certainly that not having such a policy will cost you, both in terms of the hassle of dealing with the case and also potentially financial. And I'm just flagging up that with all this happening in the world of employment, it is well worth having a review taking place of your employment terms, conditions, handbooks, policies, etc., etc., etc. And I'm not saying that in order to sell services. It's not something we do, but I'm just flagging it up because I've got your attention. And I think it's worth doing. National insurance changes, something which I can talk about with more degree of knowledge. There are no changes to employees' national insurance rates or contributions. We've seen those reduced the last couple of years. They are not changing in any way, shape, or form. So employees' pay packets aren't changing. There's no change to self-employed national insurance. However, for an employer making payments to an employee, there are employers' contributions necessary, currently 13.8%, going up to 15% from April. And in addition, you may or may not be aware that the first 9,100 of earnings don't qualify for employers' national insurance contributions. That threshold has been reduced to £5,000. Now, I've done some very quick maths on this, and I reckon that someone earning £30,000 is costing their employer at the moment about £2,884 in employers' national insurance contributions. After April, those contributions will be £3,750. So quite a substantial increase there. And obviously, the more you pay people, the more people you have, the more costly it becomes. There is an employer's allowance, which basically says for those employers who have total employers' national insurance contributions of less than £100,000 per annum. Sorry, that arrow is in the wrong direction. It is less than £100,000 per annum. The first, currently £5,000 of employers' contributions don't get paid. That is being increased to 10,500. So that's a small way of ameliorating some of these costs. The Chancellor claimed that if you employ 4 people on minimum wage, it means you won't be paying employers' national insurance. I haven't checked that maths, but that certainly was the claim yesterday. So as employers, we do have additional costs coming our way. This couldn't have been a surprise to anybody. The Labour Party hate independent schools. It was in their manifesto. Needless to say, pre-budget trawling, it was always going to happen, and here we are. It's with us. VAT on school fees, so those people that are paying school fees, I'm afraid your fees are going to be going up. And the one that I didn't see coming, maybe I missed it, is business rates. At the moment, independent school sector don't pay business rates on their facilities. Now, for those of us locally, maybe thinking about the schools we can immediately spring to mind, Woodbridge, Fram College, Colford, they're big places. Lots of buildings, administration blocks, classrooms, gyms, swimming pools, libraries. At the moment, they don't pay business rates on any of those buildings. That exemption that they've been able to rely upon has been taken away for next year. So again, there's going to be further costs going into the independent school sector, and I think we can probably guess who's going to be paying for those extra costs. There is a small amount of silver in the cloud. Of course, the schools are also paying VAT on their costs. They're buying minibuses, stationery, computer equipment, telephone calls, all the usual stuff that anybody, any business, any organisation purchases that has VAT on. The changes will mean the school is able to recover the VAT on those costs. So at the moment, they're bearing the full amount. They will be reducing some of their operating costs. But of course, we can't pretend the majority of costs in schools like this are anything other than salaries. And of course, salaries don't have VAT on. So there is going to be additional costs in here. The other piece of silver is for those schools that have undertaken large capital projects in the recent years, whether that's a new library, a new swimming pool, a new gym, new whatever, there will be the ability to get some VAT back on some of those costs, provided they qualify under the pre-registration rules. Relatively complicated area, but there will be an immediate benefit to the school on day one, albeit they're going to have further costs going forward. Now, capital gains tax. We expected there to be changes. I was a bit surprised it didn't go further than this. Surprised, but actually pleasantly surprised. If you can be pleasantly surprised about taxes going up. Remember that at the moment, current capital gains tax rates are 10% on capital gains if you are a basic rate taxpayer, 20% if you're a 40 or a 45% taxpayer, and the capital gain gets added to income to determine where you sit. If you sell a residential property, it's not those rates at all. It's 18% for a basic rate taxpayer, 24% for a higher rate taxpayer. And the reason for that higher rate for residential property was a George Osborne reform, I believe. It was seen as trying to take some of the heat out of the residential mortgage buy-to-let market. But anyway, that's been the case for some years now. There's been this penal rate applying to residential property with immediate effect. By that, I mean that contracts that were entered into yesterday or onwards, capital gains will be going to 18% or 24%. So 10% becomes 18, 20 becomes 24, and there's no longer a penalty for residential property. I find the latter point a little bit unusual given where this government's been going to date. But anyway, let's not look a gift horse in the mouth. So basic rate taxpayers paying 18% on capital gains, higher rate taxpayers paying 24%. Now just think about the implication of that. Somebody who's earning maybe £30,000, got a £10,000 capital gain, would have paid 10%, £1,000, now paying 18%, that's £1,800. Somebody, so that's quite a big difference. Somebody in the higher rates, let's pretend they're a 45% taxpayer, even to really extreme example. They were paying 20%. Maybe they've got £200,000 of income, £10,000 of capital gain. They were paying 20% on that £10,000. That's £2,000. They're now paying £2,400. It doesn't kind of feel like they're rewarding the working person there, but never mind. The other point that's worth mentioning is that the business asset disposal relief, it's been with us since the late 90s, one guise or another, one name or another, one limit or another. Basically, at the moment, taxes capital gains at 10% on the first £1 million of disposals per person. So if you have a qualifying business asset that you sell, first £1 million of capital gain, you pay 10% of it. That remains the case right the way up to 5th of April 2025, 5th of April next year. Then the 10% increases to 14%. And then in April 2026, it goes up to 18%. So even in 2026, there's a bit of a benefit in a business asset that you're selling, but not as much of a benefit as there is right now. Tax planning point then, anyone who's got assets that they're thinking of selling or are actively marketing with a view to getting rid of them and making a capital gain, make sure you get it through before 5th of April 25. And if you can't, get it through before 5th of April 2026. Basic tax planning point there. Timing is everything. And I'll come on to timing in a brief moment. So there are our capital gains tax reforms. That's it. For all the hot air that was generated beforehand, that is it. Inheritance tax. Now, I know a number of people have been looking at doing things in the run-up to the budget, trying to take advantage of the existing exemptions. Inheritance tax is probably the most misunderstood tax. We generally come across it once a generation. And there's an awful lot of misunderstandings whenever I talk to clients about taxes. Generally, I quite often find clients are quite clued up on income tax, VAT, capital gains tax, corporation tax. Mentioning inheritance tax, it's almost a blank sheet of paper. And quite often the conceptions are wrong. So at the moment, just worth reviewing where we stand. If you have a qualifying business or a qualifying farm, when you pass that on, whether in lifetime or on death, no inheritance tax is payable. Doesn't matter whether that business is worth £1 million, 10 million, £1 billion. No inheritance tax is payable if it qualifies. There are two changes that they announced yesterday in relation to this kind of asset. First of all, a bit of a technical one, April 2025, agricultural property relief is being extended to include land under an ELMS arrangement. ELMS is environmental land management schemes. Very simply, in order to get agricultural property relief at the moment, you have to be using the land for cultivation or husbandry. Under the land management scheme, you're being encouraged to grow wildflowers, look after the bees, the birds, and the beasties and things. We're not actively using the land for the purposes of agriculture, and therefore there is a strong argument that actually that land would not qualify for agricultural property relief. So in April 2025, they are just closing that kind of doubt and extending the exemption to include land under ELMS. However, in April 2026, really significant change here. Only the first £1 million of qualifying assets are going to qualify for the relief. And that £1 million is a combined £1 million. It's not £1 million of agriculture and £1 million of business. It's a combined £1 million, whichever. Once you exceed the value of £1 million, it's a 50% exemption. So inheritance tax is 40% at the moment. 50% exemption takes it down to an effective rate of 20%. Simplifying the calculation a little bit. Now that's quite a big change when you think about it, because my math suggests that if you've got a business or a farm valued at £5 million, it means that at the moment it's completely exempt. If it qualifies, probably does. under the new rules, it will mean an extra £800,000 of inheritance tax. And this, of course, is on an asset which you might not necessarily be wanting to sell or able to sell. So there's a cash flow need there. On the statute book right now, there are ways to pay that over a period of time. That will almost certainly continue to be the case. But whether paid in one lump or over an extended period, it is extra money that's got to be found from somewhere. And this does make a huge difference. Now, I'll be honest, with many clients, we don't talk very much about inheritance tax. We've got a spouse owning the business between husband, wife, whatever preferences there might be. You wait until the first has died, then do some planning after that. And that's a really good way, has been a really good way of largely avoiding inheritance tax, quite legitimately and quite legally and quite flexibly. The problem is we are now going to have to start doing a lot more planning in lifetime to try and minimise the impact of this extra tax charge. Whether that will be splitting businesses into two, so you have half of it each, whether it's going to be doing more in lifetime, whatever it might be. One thing worth mentioning is that the gifts after yesterday, so anybody gifting anything after yesterday, if the donor dies after 6th of April 2026, then it will be the new rules that apply to that gift as well. I don't want to get into the technicalities of that, probably would bore you rigid in this presentation, but it will catch things that we do immediately. So I think as a general issue, we're going to do an awful lot more talking to people about inheritance tax planning than maybe we have done historically. There's going to be more of a need to be looking at this than there ever has been. Well, ever is an exaggeration in my time of practicing tax. The exemptions are there, we're going to be much more careful around them. Key tax planning point here, basically die before April 2026. I'll leave you to think about that. And keeping to the subject of inheritance tax, personal pension pots. Again, at the moment, what happens? Any personal pension pots that are able to be transferred are transferred without paying inheritance tax. Brilliant. Again, people may not have that much worries with what I just said about the value of their business or agriculture. We do now have an issue with personal pension pots. It's a great way of passing wealth to the next generation without worrying about it at the moment. However, deaths after 6th of April 2027, those pension pots are going to form part of the estate. Now, interestingly, the administrators of the pension scheme are liable for reporting it and paying the tax on it. So the money is going to come out of the pension scheme. It doesn't have an impact on all the other assets. The money is going to come out of the pension scheme. But as somebody who gets involved in probate work, it's already quite involved. It's already lots of hurdles. It already takes far longer than it should do. This just adds a whole extra layer of administration that we can factor in when dealing with estates. And really importantly, of course, again, just picking up on my earlier point, we may not have done a huge amount of inheritance tax planning historically. We're going to have to be going forward, or at least be aware of them going forward, what the implications are. Again, tax planning point, you could probably guess what I'm going to say. You've got a pension pot, you want to take advantage of the existing exemptions. There is an option, dying before 6th of April 2027. I'm not sure that really constitutes professional advice, but it's there. Now, they were the key things that will apply to most people, I think, watching this presentation. There were a few other things I always think you should be aware of. These are things that crop up in conversation with friends, over dinner, at the golf club, down the pub, whatever. Non-dom status is being abolished. This has been constantly under attack for the last 20 years. Labour Party hate non-domiciled statuses. It means that you can basically earn money abroad whilst living in the UK. As long as you don't remit that money under certain circumstances, you can avoid paying tax on it. The status is being abolished. Probably not before time. We are one of the very few countries in the world that offer it. It dates back to the colonial era. It's going. There is a whole complicated draft of provisions coming in to protect those coming into the country very short term, but I won't go into those here. Cryptocurrency reporting. HMRC have a view about taxing cryptocurrency. They are hampered at the moment because of lack of information sharing. There is going to be a requirement for exchanges to share information with HMRC. There's always anti-avoidance provisions in a budget. This one's no exception. One of the key ones they're looking at this time around is umbrella companies. This is where you have a company between the top employer and the worker. People have been doing naughty things with it, and basically they're trying to stop naughty things happening. And the other thing that caught my eye was regulation of the tax market. Something which I always found a little strange is it's possible to give tax advice, it's possible to interact with HMRC, it's possible to make a complete haulix of things without any qualifications, experience, insurance, or anything else. There's been a consultation on this subject, and it's no secret that HMRC would much rather that the agents they're dealing with be regulated, be qualified, be insured, all those usual good worthy things. In my opinion, it's not before time. Grateful that it's happening. I'm sure it will make life a little bit more tricky in terms of more administration to be dealt with, more registrations, etc., etc., etc. But frankly, if that drives up the quality of tax advice in the UK, that will be a good thing. I suppose I would say that, wouldn't I? Tax simplification for alternative financial products. Alternative financial products are where somebody's faith doesn't necessarily allow them to do something which the rest of us regard as normal. For example, borrowing money. Commonly seen in the Islamic world, there are Islamic finance products out there. You might think that doesn't apply to you. I've advised on a few of these over the years. For example, I have a client living in Suffolk who has bought, his house was bought by a bank, and every month he buys a tiny bit back of his house from the bank. It's not, I might regard that as a mortgage and repaying the mortgage, but it's legally been set up in such a way that it doesn't breach Islamic law. It does mean that it doesn't quite work so far as UK tax law is concerned. So there are always ways, there are always every year they try and catch new products that are coming onto the market and basically bring them in line so that if somebody wants a diminishing Musharaka, which is what I just described, they don't end up paying unforeseen tax on it. Tax on EBT, Employee Benefit Trust, and ESOTs, Employee Share Ownership Trusts. These are things that the government want to encourage. Again, people do naughty things with them to avoid tax, and they're trying and close off the latest loopholes. There are some changes coming in. And my last point, which some of you will recognise, at the moment, if you're an employer and you provide benefits to your staff, every year there is a requirement to complete a P11D and report that car benefit, that private healthcare, whatever it might be. From April 2026, that annual reporting requirement is being abolished, and it's being replaced by reporting on a monthly basis through the payroll. Not before time, the technology exists, assuming HMRC's side of it works. The technology exists, it just simplifies things. The two benefits that won't be caught by this at the moment are employer-related accommodation and beneficial loan interest. So they're the two things that are not being caught, everything else is. And that pretty much wraps up where we've got to, all the things I thought would be relevant to you during the course of yesterday's budget and subsequent. We will see changes coming out in the forthcoming weeks. Obviously, all of this has got to be legislated for. There's a finance bill committee and everything else and all the usual things. Detail will be following. Obviously, we're here, we're around on the end of the phone, email, whatever, to catch up with the implication of the changes. Those of you that were invited or responded to our invitation will have noticed it came out in verse. And I was challenged by one or two of you whether I could do the entire presentation in iambic pentameter with rhyming couplets. The answer is no, not doing it, can't be done, and you would all tune out, probably. But I did promise at the treat that I would try and do something. And here it is, a little ditty to do with the budget. So you came here looking for a Halloween poem and instead found out how much the country's owing. On All Saints' Eve, it's trick or treat with candy and pumpkin soup to eat. It's early morning and the subject was deep, so I do hope that no one fell asleep. Labour are in power, farewell to Sunak and Gove, but we'll be here for you at Quove. We're ready for some questioning, expecting emails and the phone to ring. But we hung around on Zoom for a bit, and I'm really sorry the poetry's poor. You'll be delighted to know that's it. Time to tune out, but as I say, any questions, give us a shout. Bye for now.